Instead of buying individual stocks or bonds, you have the possibility to buy funds. Chapter 9 takes us deep into the world of investment funds, showing how mutual funds actually work, why most of them fail to beat the market, and what a thoughtful investor should watch out for before handing their money over to a fund manager. Mutual funds and other investment companies exist to do two things for most individual investors: simplify investing and provide instant diversification and professional management. Graham begins by laying out the main families: open-end funds, what we usually call mutual funds whose shares you can sell back to the mutual fund instead of to the stock market; closed-end funds, whose shares you can sell back to others on the stock market; balanced funds, a mix of bonds and stocks, stock funds, bond funds, load versus no-load funds, etc. Funds are huge business. They make investing accessible and have helped many people save sensibly who otherwise might have been lured into poor choices. So the big questions Graham asks are sensible. Do funds give you an edge? Are there funds you should avoid? Can you pick types of funds intelligently? First, the industry's overall track record. Graham's bottom line is that funds as a group have served investors well. For many ordinary people, investing in funds has been safer than trying to DIY stock picking, and fund investors often fare better than the average self-directed retail investor who gets distracted into speculation. At the same time, funds in aggregate tend to return roughly what the market returns. They are not magical outperformers, and their costs matter. That leads to the central practical point in the chapter and in the commentary. Past performance is a poor predictor of future performance, and costs are a very reliable predictor of lower returns. The commentary unpacks why. Winning fund managers attract assets. Asset elephantiasis. Managers get poached. Small experimental strategies don't scale. Trading and operating costs rise. Managers start herding into the same big names, and fees never shrink even when past returns cool. In short, a manager who looks brilliant today can look ordinary or catastrophic tomorrow, and your fund's rising size and costs will often erode whatever edge that manager had. Graham uses the performance fund phenomenon of the 1960s as a cautionary tale. The book's Manhattan Fund is the classic example. Manhattan posted fireworks early gains, grabbed headlines, and then produced severe losses and distressing portfolio holdings. The moral, spectacular short-term returns often reflect concentrated, speculative bets that are fragile and not sustainable at scale. If you're trying to choose among funds, Graham and the commentary give clear, practical guidance. Don't pick funds solely on recent returns. Hot sectors cool fast. Yesterday's winner is unlikely to remain a winner. Costs matter first. Lower operating expenses and lower turnover translate directly into higher returns for you. An index fund's tiny expense ratio gives it a huge long-term advantage over high turnover, high-fee active funds. Look for alignment of interest. The best managers often have substantial personal money in their own funds. When managers are big owners, they are less tempted to chase size or fees at shareholders' expense. Prefer funds that dare to be different and that have the discipline to close to new money. Managers who stick to a clear, repeatable strategy and who close the fund when it becomes too large for that approach are showing investor-friendly behavior. Be skeptical of flashy marketing and of funds that trade like day traders. High turnover equals high hidden costs. Commissions, bid-ask spreads, taxes. Graham also discusses closed-end versus open-end funds. Closed-end shares often trade at discounts to net asset value. Buying a diversified closed-end fund at a 10 to 15% discount can be a sensible way to get extra return compared with paying a typical mutual fund's 8 to 9% front load or paying higher net price. The math Graham walks through shows that in many realistic scenarios, the closed-end buyer keeps an advantage even if the discount widens a bit. That said, closed-end funds are a smaller, sometimes illiquid market and require care. On balanced funds, those that mix bonds and stocks inside one vehicle, Graham's practical suggestion is worth noting. If you want the bond component mainly for stability and income, you may be better off buying bonds or short-term government issues directly rather than accepting a mutual fund's modest yield and extra costs. In other words, use funds where they add clear value, convenience and diversification for equities, or exposure you can't cheaply replicate yourself, but don't automatically bundle everything into a balanced fund without checking the economics. The commentary adds a modern capstone. For most investors, a low-cost total market index fund is the single best choice. It's boring, yes, but its tiny costs compound into a big advantage over decades. If you choose active funds, prioritize low fees, manager ownership, differentiated portfolios, and a demonstrated willingness to limit growth. And be patient. The investors who panic and trade in and out of funds based on short swings do worse than those who stick with a sound plan. Finally, how do you know when to sell a fund? Don't act on 1 or 2 bad years. But do act if the fund's strategy materially changes, if expenses creep up sharply, if the manager's behavior becomes erratic, excessive trading or tax churn, or if the fund drifts away from the stated discipline that attracted you in the first place.